Thank you for watching the Community Spotlight. I'm your host, Atia Harris. Today I have a wonderful guest in the studio, William Johnson, CPA of Account Tax Johnson Accounting. And also he's been in practice for more than 25 years in multiple states. And so today we're going to talk about things that trigger an IRS audit. I want to encourage you to go ahead and get your pen and pad ready because none of us want to do these things. How you doing today, William?
I'm fine, Atia. How are you?
I'm doing excellent, excellent. Great smile. Okay, tell us a little bit about yourself, William.
Okay, first, as you said, I'm a CPA, and I've been practicing over 25 years, and we specialize in accounting and represent people who are in trouble with internal revenue. And for the last 5 or 6 years, that part of our business has been growing by leaps and bounds.
Okay, so every time you turn around now, somebody's getting audited. Before, I didn't know people that were getting audited. Now, oftentimes people I know, hey, I got an audit, I have an audit. So this thing is something that has increased with the IRS. Also want to mention that you're actually an all year round accountant. Your office is open all year round, correct?
That's correct.
All right, and then you also do audits for folks. You audit books as well. And as you mentioned, want to repeat that you assist folks that have issues and are in IRS trouble, so that makes you an expert here today.
That is correct.
Okay, so talk to me about the IRS. What's going on with them? Why do we think of them as the big bad wolf? Are they the big bad wolf, and have they increased their audits?
First of all, everybody believes that IRS have too much power. They are in charge of collecting taxes. Of course, the government, we can print money, but we would prefer not to print money. So the IRS is supposed to collect money. And there's a problem, they call it the tax gap. That's the difference between what we pay and what the government thinks we owe. So that's where audits come in. The government sent a team of people out to try to collect that tax gap.
Okay, now I want to say that I can think of a business that I know that got audited, and it's very important that people keep up with their records, and I want to know how many years they need to keep, because this business, you know, actually wound up being in compliance only because they could produce documentation that they kept good records. And I just want to say that the representative that came into them was trained to be very cold, and I'm not saying they're all like that. I was there when this representative came, very cold, very uncaring, and very accusatory. You owe us this, you owe us that. And then this representative was dumbfounded when they came up with all their documentation. So we do have some errors that's going on. They actually, I believe, wound up owing absolutely nothing because they did their duties that they were supposed to do. So it also puts me in the mindset of individuals that don't file taxes, and then all of a sudden they get audited by the IRS and they're hit with a bill. That doesn't mean that bill is accurate. Can you explain this, please?
Okay, first I talk about the no change audit. And I've gone to many cases where the IRS accused, you may say, a client of not reporting all the income or accelerating expenses that didn't exist. That's where the documentation, like you talked about, without that documentation, you're in trouble. That's why the first person you should hire should be an accountant or CPA, because mostly if you go into business, regardless of what you do, you know how to run your business, but you don't know how to keep books. You don't know the tax laws, and you don't have to. They got experts to do that.
Okay, so we learned today, and everyone needs to know, if you get audited, it's best that you seek a third-party professional that's seasoned to assist you with that particular audit, because, for example, if you don't file your tax returns, the IRS is going to file them for you. So now you don't have all your documentation, you don't have all your write-offs. Now, I'm not saying that they're always wrong. I'm pretty sure in many instances that they are right. But how many years should we keep our records?
Well, first of all, it depends. If you got records and it have anything to do with real estate, you should keep those records 5 years after you dispose of the real estate. But if you just got a business, 5 years is the statute of limitations. but I always tell my clients to keep them 7 years.
Okay, so your recommendation is to keep all your records for 7
7
years.
years.
All right, well, let's talk about the individual that actually does their tax returns and then they get a 1099 or a W-2 after they did their taxes and they turn around and ignore it. They don't amend the taxes, which they're supposed to do. Is that going to come back to haunt them sooner or later?
Of course, a 1099, mostly when you talk 1099 miscellaneous, that's just documentation that one copy always go to Internal Revenue. Of course, the other copy go to you, and that's one of the audit triggers. In fact, that's the number one audit trigger where documentations don't match. Your W-2 when you work for somebody. You may work for 3 or 4 different employers, and you may miss a W-2. If you are not an employee and somebody pay you over $600, they have to send you a 1099 miscellaneous. And if, when you do your tax return, your data don't match IRS records, then what they will do is adjust your tax return. But when they adjust your tax return, they don't know your expenses. All they know is the income side. So they'll adjust your tax return according to that extra income and send you a bill and a little friendly letter say, if you agree, send us a check, sign this form. If you don't agree, then send somebody down and prove that you're right and we're wrong.
So oftentimes at this point you need to get with that professional, have all your documentation looked at, because even some people just get documentation like this and they accept it and they move forward when really they should be seeking help, correct?
Definitely should
We
seek
can't
help.
emphasize that enough, that if you're in this situation, you seek help.
Yeah. If you're not in that field, put it this way, I'm a CPA and I've been practicing 25 years. If I wasn't in the business of representing people before the Internal Revenue, and if I had a problem, I would hire a professional.
Okay, so let's say we have done our tax returns, we have all our 1099s, all our W-2s, all our proper business documentation, but it's certain things that we can put on our tax returns that trigger an audit, like maybe a high amount of tithes that's paid or something of that nature. Can you break down the different things that you can put actually in your tax return that will trigger audit possibly?
Yeah, first, and a lot of individuals fall into this trap. There are guidelines, and it's based on adjusted gross income in relation to itemized deductions. And as you mentioned, the one that everybody, not everybody, but a lot of people try to exploit contributions. If your contributions exceed 10% of your adjusted gross income, then there's a good chance that you're going to be audited. If your medical expenses exceed 7.5% of your adjusted gross income, there's a good chance that you're going to be audited. If your mortgage interest on a primary resident and or second home exceed 20% of adjusted gross income, it's a good chance that you're going to be audited. It don't mean that you're wrong, but it means that they're going to look at it. And when they audit you, they can audit you for one area, but they're going to look at your whole tax return since they got you.
So it's kind of interesting to me that a person that chooses to go over and beyond in giving would actually, possibly trigger audit.
Yeah, and I'll tell you, the number one area when people go over when the contributions, it's the person, that family member is a minister, and somehow that particular church says all churches are nonprofit, so they have a tendency to give more, and somehow they receive a benefit, and Internal Revenue know that.
Okay, all right. Well, that's definitely something to look into. Well, let's talk about this famous thing with these kids we have going on out here. We got several scenarios with these kids. The first scenario that I want to put on the table is you have a child, they have 2 parents that are not together. One parent is the majority caregiver of the child, but the other parent runs down and gets their taxes done first and to try to get that EIC, that Earned Income Credit. What does a person do? And I know that's going to trigger audit if somebody complains, correct? So what do they do?
Okay, normally what triggers the audit, 2 people claim the same child.
Okay.
And of course, you know that because of the matching. You got the Social Security number. Two people can't claim the same dependent, and the parent or the person that gets the name first. I said a person because sometimes you run into boyfriend, girlfriends. They let the boyfriend or the girlfriend claim the child, and it's okay this year while they're going together, but next year they break up. But guess what? The girlfriend or the boyfriend still have that Social Security number, and when they file first, they will give them the earned income credit for the person that claimed the child first. Don't mean that they the custodial parent. It just means that they file first, and when the real custodial parent files, their return is rejected.
And so now we have a challenge. How do they challenge that?
Oh, now, well, first of all, you got representation. You can go down there yourself and take documentation like birth certificates, Social Security cards, and proof where the child go to school. And two people can't prove it. Only one person got that documentation as proof. And then they will eventually adjust it. And adjust it mean they'll give it to the proper parent, and then they'll try to take it from the other person who claimed it incorrectly. And of course, they don't have that money.
They had a ball with that money.
So there's a problem. But they will finally adjust it. But that could take 6 months. It could take a year.
So you can actually wind up having to pay back, or maybe setting up a payment plan on that as well.
Oh, yeah. And, well, and sometimes they call it rent-a-kid.
Rent-a-kid. Let's get on that rent-a-kid, selling a kid. Now, you do have people that's just giving kids away.
No, they rent the kids.
Okay, renting the kids out, selling the kids. I shouldn't say selling the kids, should I?
No, just rent them.
They renting them kids out?
Yeah.
Okay, all right. So talk to me about that, because I was told that they were honing down and cracking down on that. There's a whole special department just to trace down you allowing somebody to rent your kid.
That is true, and it's normally a woman 4 or 5 kids and no job, and she getting public assistance, or it could be a guy getting public assistance, no job, so they can't really get a refund because they didn't pay anything in and they didn't make no money. So what they'll do,
I think there's more people than that doing it, but okay, go ahead. You cleaning it up.
what they do is in the average earned income credit, if you put the income right, is about $2,500. So they will, give me $1,000 and I'll let you claim the kid. So in the single person made $1,500 free, and the parent of this child made $1,000 free. And just think, if you got 4, that's $4,000 untaxed free money.
Situation. Everybody's happy.
Yeah, everybody happy.
Except the IRS.
Except the government. So now, that's why they got the checks and balances now. If the child is on social services, they know. If the child is getting food stamps or anything like that, they know. So
they are really heavily monitoring this.
Yeah, but the problem is they working maybe about 2 or 3 years behind. So the person, by the time they get caught, they probably got $10,000 worth of illegal money, and the government can and they will prosecute sometime because it's fraud and it's felony. So oftentimes they'll just say pay me.
Wait a minute, are you sure taxes are legal? There's some people out there that say you don't have to pay taxes now. Let's address that.
And how much time?
And they haven't paid taxes now. That might trigger something.
And how much time do they do when they catch them? Yeah, but those cases been to the Supreme Court, and a lot of people I get it every year. I'll probably get one person to tell me that taxes is voluntary, and they volunteer not to pay.
They voluntarily decline to pay the taxes.
And when they come in my office, I show them the door. I offer them like a glass of water and show them the back door. Because I don't want none of my other clients still coming out the front door. But no, believe me, if we didn't have to pay taxes, we wouldn't pay taxes. But that's why a professional comes in, because you shouldn't have to pay more than your fair share of taxes. There are a lot of legal, you may call them loopholes, but it's the tax law. And as long as you abide by the laws, you can minimize your tax liability, in which I think that's fair.
Well, I think it's fair too, because this is a little bit off topic, but what type of society would we have if even 75% of the people said, I'm not paying taxes?
Just think, how do you?
I mean, where's your military?
Yeah.
Where's your government? Where's your schools? You know, where's your post office? I mean, where are these things at?
You couldn't exist. And
So while you trying to beat the system, you need the system.
of course, but the people who try to beat the system are normally crooks. Now, normally it's okay because you don't want to pay more than your fair share. And that's the tax laws. They got many benefits for, they got credits for going into business. They got credits for hiring people. They got all kinds of breaks the legal way. And I would suggest that everybody just abide by the law. I wouldn't suggest that anybody break the law, especially because they could put you in jail.
And I think you should study the laws too, or actually get with a professional such as yourself and sit down and review these laws, because I know a man right now, I call him the money man. He's never been married. He doesn't have any kids, and he has a W-2 job, but he also has a business set up on the side, and he gets a refund, and he never pays taxes. We have this myth, if we're single, we have no kids. And when I dreaded it, but you have to do it now. You have to do it because it's for the greater good. But this man, because he has a business set up, and it's a part-time business, along with what he's doing, he has extra write-offs. So he has mastered, in that particular area.
Okay, 60% of my representation cases come from that exact type of client. And this is what happened. Like everybody know, if you got a job, you work for a corporation, they give you a W-2. They withhold federal, state, and Social Security taxes. And what he's trying to get, and a lot of people try to get all of those federal taxes as a refund. So what you do, you set up a business, and the business always lose money. Every year, the business lose money. When a business lose money, it reduces your adjusted gross income, which reduces your tax liability, which reduces the amount of taxes you owe. And because you take that loss, then you normally get a big refund.
Now, can I say that he has been audited and he passed his audit because he does great? He's very organized and has great documentation.
And I was getting ready to hit, it could be a legit business and he suffered the loss. If he running a legit business, and he could be set up as a S Corp, a Schedule C LLC, it could be a legit business. But every time I get those type of cases, and most time I win them, because by the time we get to Internal Revenue, the documentations are there. But if you just got a fraudulent company where your goal is to just lose money year after year and reduce your tax liability or get a refund, then IRS got a little law. It's called a hobby rule. And if you lose money 3 out of the last 5 years, they can come and say, you're not trying to make any money. This is a hobby, so you're not taking a loss on a hobby. So
Okay.
they got all kinds of
Let's go
laws.
over a couple more war stories real quick. There's a lady that I met that was planning on buying a house. This is when they had all those great housing tax credits out. Please give us another one. We need another one. We're still waiting. We've been waiting for a couple years. The last ones were so great, we haven't seen any more. We need another one. So she was planning on buying a house, and she went and got her taxes done by an accountant, or I don't know, someone that does taxes. And they told her, since she was planning on buying that year, go ahead and apply for a housing tax credit. So she got a huge refund, okay, back, doesn't own a house, and got that credit back, and then was surprised when she got a letter in the mail from the IRS saying, send me your HUD-1 document or some type
And
of
you know what
proof
that HUD-1
that you
document is.
actually purchased a house. How do they know she didn't purchase that house?
Now you and I both know all real estate transactions. What the first thing they got is your Social Security number, and that's that matching process I talked about when they
Housing credit,
and
no
when,
house purchase over here.
yeah, when they matched it up,
It wasn't
it
matching.
wasn't there,
Okay.
and that credit could have been $8,000 that year. That was
So, from my understanding, this particular, I don't know if I should call him an accountant, but this professional helped a lot of people do that. So sometimes, can you have a bad person that does your taxes that helps you get an audit triggered on you? I've heard of that too.
I've heard of that more than one time, almost every year. And the worst thing you can have is a bad professional, because, and I'll tell you how that works too, and what they'll probably do. So if you come in the office and do your tax return and you get a $2,000 refund, and he look at it and tell you that I can play with some numbers and I can get you a $8,000 refund, but you got to give me $2,000.
That's when you know you're in trouble.
Yeah, but and that's the way the scam
You
goes.
should know you're in trouble right then and there. Give me two.
No, but people are so gullible, and for a few $1,000s, you'll be surprised what people would risk for a few $1,000s. But think of this person that does it. If he do that 100 times, that's 100 times, and he $2,000 every time. But what they normally do, all of a sudden, that's a self-prepared return. They don't
They didn't
sign
even sign it. You think they signed
Oh,
off
no,
on it?
no.
They didn't even sign it.
They
Here,
don't.
mail it in yourself
That's
and bring me my two.
That's right. Or they'll get
Collect it.
They'll electronic file it for you, and
As if it's you.
that's right.
Who would have
yeah.
known they could do that trick?
Yeah, but in every year again, you see, even around Charlotte, you saw the news where they got closed down because they were doing that type of scam. So it's out there.
So there are some folks that legitimately owe. You know, I met a gentleman that sold a restaurant. I think I sent him to you to be evaluated.
Yeah.
That wound up owing a large sum of money because he didn't count it in the taxes. I mean, there are some people, you take their write-offs and everything. The IRS is correct; they legitimately owe. But you can do an offer and compromise. Can you explain that, please?
Yeah. First of all, an often compromise is you look at your tax bill and say, yes, I owe that. I owe you the money, but I don't have any assets. I don't have no money in the bank. I only make a small amount of money. Even though I know I owe you $100,000, if I can pay you $20,000, X amount per month for 24 months, will you take that offer? When you put that offer in, you have to provide a financial statement, a balance sheet that shows your assets and your liabilities, and an income statement that shows your income and your revenue. They will evaluate that, and after they evaluate it, they will come up with one of three situations. One, they may accept it as is. One is they reject it, or they may make a counter offer. And oftentimes they make a counter offer because when I'm preparing the offer, I do it low because I know that they're going to make a counter offer. And if they accept it, then that debt is wiped out. That other $80,000 between the 100 and the 20, you don't owe it.
Okay.
But guess what? The rest of your life, you got to comply.
Okay, so I'm thinking of married couples. There's some type of sticky situation between married couples where you can have one spouse that's audited and the other one looks like they owe. We got sloppy situations like separations and divorces going on. Can you give us this scenario and how a married couple should file their tax return?
It depends.
It depends. Give us the depends.
Now, because you have a lot of marriages and first marriages, second marriages, and I'll tell you a situation where you should file separate returns. Say if you married and one of the spouses owe child support. And if you file a joint return and you get a refund, guess what? That money will go toward his child support. And you, as the current spouse, you don't want your money going to support his ex. So in that case, I would say file separate returns.
Okay.
But a separate married filing separately, the tax laws are really harsh. You don't get a lot of breaks like you do for married filing jointly. But in an ideal situation, married filing jointly would be the most tax efficient way to go.
Okay, so if you can work around that, then it'd be more efficient.
And
Make sure there's no back child support.
that's just one example. And I'll give you another example. Say if you work for a corporation, you get a W-2, and your spouse got his own business. He make a lot of money, but he don't pay his Social Security taxes, or he don't pay his federal taxes. And the same situation, when you start filing, they will come after you to pay his tax liability.
But can you get out of that? I mean, it's not your liability, it's his. Are they going to pull the married card on you?
Yeah, it's called an injured spouse.
Injured? That spouse is definitely injured.
That's right. Believe me.
That's definitely an injured spouse. Okay.
That is correct. And I do those on a weekly basis. It's not a week. And what it does, you calculate the tax return as if it was single, and you separate the income, the tax payments, and the deductions separately.
So is that an amendment now? You're amending the taxes
No,
now, or you just do it from the onset? Married filing separate from the onset.
That's married filing separate from the onset, but the injured spouse is after you did the tax return and they took your money. And I'm going over here to try to get your money back. I'm saying no, she didn't have nothing to do with that. But then again, as long as the couple is doing great, it's okay to take her or his money to pay the other debt. But when they start doing bad, and don't mention after the divorce, because you can be divorced and they still taking your money to pay off his or her liability.
Well, we appreciate you for coming on the program today, William. The bottom line is that we learned is if we get a letter from the IRS, we need to seek professional advice. And based off of some of the examples we gave, we need to probably make sure we're with a certified accountant, some type of CPA to do our taxes. We appreciate you for tuning in to the Community Spotlight.